Okay, so welcome everyone. And Delia, thank you for being here. And whenever you're ready, off you go.
All right, Tatiana, first of all, thank you so much for inviting me and giving me this opportunity to speak with your staff, with the employees of the town of Needham. I am always happy to impart information that can allow people to have the necessary tools and information so that they can plan for their retirement, which is a very exciting chapter in our lives, but it's definitely a phase of our lives that requires some homework, some preparation, so that we can make informed decisions. So what we'll cover today is we're going to talk about basic eligibility for Social Security. Some of you, this may be a second career. Some of you may have had or continue to pay into Social Security. So again, everyone's work history, everyone's life is different. So, but for most of you, you may or may not have had some contributions in the private sector. So I'm sure as you age and you're thinking about your retirement, you're thinking, well, what about Social Security? What about those credits I earned or continue to earn? How do I qualify? Will I qualify? And what about Medicare? We're going to talk about that. That's also a very important piece of your whole Social Security retirement package. We're going to talk about those provisions that cause us to have to compute your benefit a little differently because you have a pension that you did not pay into Social Security during that working time. Okay, we're going to talk about that. We'll talk about working in retirement. Some of you may have concerns about that. Maybe some of you are going to retire from the town, but perhaps you still want to do some sort of work or self-employment part-time, and you're thinking, will that affect my Social Security? We're going to talk about that too. We'll talk about the difference in taking benefits early versus delayed. All different factors that come into play when you're deciding what the best age for you is to start collecting Social Security. All right, so if we can move to the next couple slides. The next one is basically just saying, please not to put any personal information in the chat. You're welcome to ask questions later, but please don't put any personal information out there, okay? Next slide, please. So Social Security, I know for most of you, you're paying into a pension, which is great because that's something we're seeing go away. Not many employers these days offer a pension, but for those that do not, the message has always been that Social Security is an important benefit, one of the most important pieces of social legislation ever to pass. We're paying over 60 million people every month a retirement check or a disability check, survivor benefits, but it was never meant to be anyone's sole source of income in retirement. We always looked at Social Security as a foundation, something to build upon. And thankfully, in your case, hopefully you have some credits under Social Security to qualify you for a benefit. You have your pension, and again, even so, even with pensions and a Social Security check, even still, if you speak with a financial planner, financial advisor, they talk about having different tiers, of income, different sources of income. Because Social Security for the average worker that has paid only into Social Security during their working career, it's only a replacement of about 41% of their pre-retirement income. So you can see why no one can really be expected to live on just Social Security. It's why, especially with younger folks, it's important that they save, that they or invest and put money aside so that when they retire, they have other streams of income. Because Social Security, again, for the average person, only about 41% return of their pre-retirement income. Next slide, please. So what is FICA? FICA is that deduction, one of many on our pay stubs, right? As town employees, same as employees of the Commonwealth of Massachusetts, you're not paying into FICA. That was a decision made on a higher level that municipal employees, state employees contribute into their pension and not into Social Security. You may, however, be paying into full FICA if you have a job on the side, or maybe some self-employment income on the side that you're paying income taxes on. as municipal employees, you're only paying into the Medicare fund, that 1.45. So what is that giving you? That's giving you eligibility to free Part A of Medicare, which is the hospital insurance. And we're going to talk about more about Medicare in the upcoming slides. But that's what that deduction is giving you, so that when you turn 65 and you're retired, you can enroll in Medicare, free Part A, and then Part B as well. Everyone pays for Part B. That is the medical insurance that covers us for outpatient care. And again, we're going to deep dive into Medicare in the upcoming slides. Next slide, please.
Delia, before we move along, I just want to ask you a question. Would you like people to ask questions as you go or hold them for the end?
I think it's better if we hold them till the end.
Okay, and for everyone who's watching, if you just raise your hand using the control bar at the bottom, then we will call on you once we're ready for Q&A. Thank you, Delia.
Sure. So how do we qualify for a Social Security benefit? Well, as a municipal employee, you want to make sure you have at least, if again, you're close, right? You want to have at least 40 credits paid into Social Security, 40 credits or 10 years of work. Why 10 years? Well, you can earn credits up to 4 per year maximum. How you earn those credits is through FICA deductions, but you have to earn a certain amount to earn a credit. So for this year, and again, this amount changes every year. For this year, for 2023, every time you earn $1,640 in the private sector, or again, in self-employment, if that's the case, that gives you 1 credit. You can earn up to 4. Okay, so it doesn't take a whole lot of money to earn those credits. Maybe some of you have 38 or 39 and you're thinking, is it worth it? As you can see, you don't have to earn a whole lot of money to give you those credits. That'll give you a guaranteed benefit. And again, it's not going to be significant, but hopefully enough to cover your Medicare when the time comes to enroll in Medicare, and maybe a little extra. But again, need at least 40 credits or 10 years of contributions into Social Security to qualify for something. And again, just to dispel one of the many myths that are out there, I hear all the time, oh, I work for the town. That means I can't get anything under Social Security. That's not true. As long as you have at least 40 credits, you're guaranteed a Social Security benefit. Now, where it can be true is if you don't have 40 credits, and you're thinking, I'll collect on my spouse, or I'll collect on my ex-spouse. And if you've had a career and will have a significant pension, spousal benefits under Social Security were meant for the spouse that stayed home, that didn't work, right? So that's when someone won't receive any Social Security benefits. If they were counting on receiving on a spouse or a former spouse or a deceased spouse, okay? Because spousal benefits under Social Security are to protect, were meant for the spouse that didn't work outside the home. However, how you're guaranteed a Social Security benefit is if you yourself earned at least 40 credits. Next slide. So how do you know if you have those 40 credits, or how can you find out if you have those 40 credits? Well, you can easily go onto our webpage, onto ssa.gov, and hopefully you all did that before this session to determine if you have those credits or not. When you set up your My Social Security account, which again, to set it up, if you don't have one yet, you have the choice to authenticate, to verify who you are with us through either ID.me or login.gov. Those are the two companies we use, government-backed agencies, to verify your identity, because we don't want someone that found your Social Security number and knows your name and date of birth to go in and access your private, personal Social Security benefit information. So just be aware of that. But your statement will show you if you have enough credits. You'll see a dollar amount there when you click on your statement. If you do not, it'll tell you how many you're short. Another important thing to know is when can you start retiring under Social Security's system? When can you start collecting at the earliest point? Well, although they've made changes under the 83 amendments under the Reagan administration, they did increase the age to receive full benefits or unreduced benefits under Social Security, but they did not take away early retirement. So age 62 is the earliest age anyone can apply for Social Security if they're eligible. So that did not go away. However, what changed was for people born after 1938, what was 65 originally as the full retirement age was incrementally increased by 2 months until it became 66 for those born between 43 and 54. Those are the baby boomers we're seeing right now. 66 is the full retirement age, but then it bumps up again for anyone born after 55, and then it becomes 67 for everyone like me, born after 1960. That'll be 67 would be my full retirement age, but I still have the option of collecting at 62 if I want. And we're going to talk about things to think about whether you want to collect benefits early or maybe you want to put off receiving them. Next slide, please. So again, I said early retirement, age 62 is the earliest point at which an individual can be eligible. Now, things to consider. Number one, as you can see through this chart, that's a reduced benefit, right? It's about 25% less for someone whose full retirement age is 66. It's 25% less than waiting until age 66. The other thing you have to think about if you want to take benefits early is that Social Security does put a cap or a limit on how much you can earn from your job if you are under full retirement age. However, that limit, that cap is gone once you reach full retirement age. So if your full retirement age is 66 or 66 in 2 months or 66 in 3 months, once you hit that full retirement age, from that point forward, you can earn whatever you want. And in that year, much more. And again, we're going to talk about that in the upcoming slides. But look at how much it grows if you delay collecting your benefits even beyond your full retirement age. You notice it goes up 8% for every year that someone puts off or delays collecting Social Security. But it does max at 70. So if you wait till 71, you're not going to get $1 more than you would at age 70. But these are strategies, so to speak, to maximize what you can receive from Social Security. Some people that maybe don't have pensions, maybe some people that are going to rely more on Social Security than others, they're still working, they're still healthy. They may utilize these strategies to receive the most they can. Why? Well, most of us are going to spend a third of our life in retirement, and that's great, right? But as long as we have enough income to carry us into that long retirement. Now, again, these strategies are not for all. Does it make sense for someone that's sick and unhealthy, that doesn't have longevity in their family, to put off receiving benefits? Maybe not. But again, it's a very personal decision. These are just FYIs, information to help you decide when is the best time for you. Another thing to consider, and again, as municipal employees, this is a perk that you have, that when you retire, you don't lose your health insurance. It carries, of course you have to pay for it, just like we all pay for health insurance, but you have the option of continuing that coverage. But most people in the private sector, they leave their job, they retire from their job, their insurance ends the following month. So they'd have to wait till age 65 to enroll in Medicare. So again, that's a factor that, comes into play when we're deciding, when should I start collecting? Should I take benefits early? Should I wait? Health insurance is a big one. However, now that we have the Affordable Care Act, that has changed things. Thankfully, because of the Affordable Care Act, and of course in Massachusetts, we were fortunate in that we already had a plan that is very much like the Affordable Care Act. We already had a plan in Massachusetts. that people could enroll in for that period prior to age 65. So if someone did, from the private sector did retire at 62 or 63, they could sign up under the Health Connector, right, in Massachusetts, and have at least some level of insurance until they turn 65. Because, with the connector plans, they kick you off when you turn 65, because now it's a shift of burden. They want you to sign up for Medicare. And as municipal employees, just like the employees of the Commonwealth of Massachusetts, when you are retired and approaching age 65, you too will have to enroll in Medicare. You don't lose your insurance from the town, just becomes your supplement to make it complete, to make it whole. Again, we're going to talk about that in the upcoming slides. Next slide, please. So again, if you don't already know what your full retirement age is, and for spousal as well, these are the full retirement age based on the year that you were born, and the corresponding reduction if you take benefits early at age 62. Next slide, please. So working while receiving benefits. So again, these amounts are adjusted every year. They go up as long as there's a COLA, a cost of living adjustment. All these amounts go up. The amount needed for a credit, the earnings limits are all adjusted. This year, for a beneficiary that took an early retirement, they can earn up to $21,240 this year without losing any of their Social Security benefits. However, what happens if they go over that? What happens if they earn in excess of that limit? Well, when our friends from the IRS report that to us, you would have to pay back $1 for every $2 that you earned in excess. $1 for every $2 that you went over, that $21,240 figure. This amount does not include pensions. It does not include annuities. This is just what's reported to the IRS, which is then reported to us from W-2 earnings, or if you're self-employed, your net from self-employment. Look at how much more, however, you can earn the year that you attain, or the year that you reach full retirement age. So let's say your full retirement age for you is 66. And you're going to be 66 this year, and you want to collect Social Security. If you were to file this year, in the months leading up to your birthday, the month of your birthday, you could earn up to $56,520 this year. And from the month of your birthday forward, no limit, could earn whatever you want. And another thing I want to say on the side, when you're thinking about those offsets, that windfall elimination provision, the WEP, that doesn't affect you unless you're receiving your pension and Social Security at the same time. So if your full retirement age, remember, the earnings limit is gone from Social Security, and that offset doesn't apply until you start receiving your pension, just an FYI. But what happens if you exceed that amount? Well, the payback is $1 for every 3 when it's in the year that you attained full retirement age. And remember, the month you reach full retirement age, from that month forward, no limit. Next slide, please.
And just a clarification, this is calendar year, right? This is measured
Correct.
calendar year. Thank you.
Correct, calendar year. And our calendar is January to December. I know with this towns, it's your fiscal year begins in July, right?
Yes.
So how do we determine your benefits? So unlike your pensions that look at the highest 3 years of earnings to compute your benefit, ours is different. Social Security is different, which is why, another reason why we encourage everyone to go online and look at their statement every year, because we take into account a lifetime of earnings to calculate, to compute your benefit. This is why we tell everyone once a year, look at your statement, make sure your earnings are correct or your self-employment is posted, because it matters. You don't want to find anything missing. You don't want to find anything discrepant, because it matters. It's not the last 3 or it's not the last 5. It's a lifetime. We're looking at your best 35 years. Yes, I know you're thinking, she said 10 years of work. Well, 10 years of work is to qualify for something, a minimum benefit, right? But our formula is looking for the best 35 years. So if you only have the 10, we're putting in zeros for those remaining years, okay? You can fill in those zeros, wipe out those zeros. If you leave employment with the town of Needham and retire, and then maybe you find a job in the private sector, even if it's part-time work, when those earnings are reported to us, and they will be, your benefit under Social Security will be recomputed. And you don't even have to ask. It used to be you had to ask us to show your W-2 and say, can you please recompute my benefit? I worked last year. Now, in the age of technology that we're in and data exchange that occurs so quickly from IRS to Social Security, before you even think about it, we already have your W-2 earnings, and we'll send you a letter saying, we've increased your benefit to give you credit for your earnings from 2023. Now your new amount is X, okay? Whereas, just to give you an example, myself, by the time I retire, God willing, I'll have well over 35 years paid into Social Security. So if I get bored in retirement and pick up a little job or even some self-employment, yes, I have to pay into FICA. That's IRS says that's a mandatory tax. If you work, you have to pay it. Will it increase my Social Security benefit? Absolutely not a penny, because very unlikely that any employment, any work I have post eligibility in retirement is going to be better than the years I had in my work during my full-time working career. But as town employees, municipal employees, or even state employees of some of your, spouses, family members, same thing. If they go back and do, even if it's part-time work and you're paying FICA tax, that additional year will wipe out a 0 year and give you a little boost. Not huge, but it will give you a little boost in your benefit because it wipes out a 0 year. Next slide, please. So when you, hopefully have already done this, but when you go into your My Social Security account and you click on your statement, part of the planning page now includes some FYIs, some informational sheets dependent upon your age, whatever age you're at. So if you're 60 or 62, it's going to include information about Medicare. It's going to give you information to think about when you need to enroll in Medicare. Of course, it's age appropriate, and they break it down by 10s, like so 40 to 49, 49 to 59, and so forth. So it's age appropriate, the information that you're seeing on your statement. It also now, it will identify, if we see zeros on your statement, the system knows, they probably worked for a municipality, or they probably worked for the state, or non-covered employment, right? It could even be outside the country, non-covered employment that they did not pay into Social Security. So it'll include information about the windfall elimination provision and about the government pension offset. So it's been enhanced to be intuitive to identify those people that have many zeros on their Social Security statement as an FYI, like, the windfall elimination provision is probably going to apply here. So this way you're not misled thinking that your Social Security is going to be one amount when in fact it may differ because of your eligibility to your non-covered pension. Next slide, please. So that statement, that prior page, if you noticed, I know it's kind of small, but it includes estimates. It'll show age 62, your full retirement age, and age 70. But if you're thinking, well, what would it be in my case? Because I'm going to be affected by that windfall elimination provision. And what would my benefit be if I wanted to take it at 63 or 64 or 64 in 2 months? Well, you can log in, same thing, go into your account and then click on the estimator, right? We have online calculators that will even compute for you your benefit based on that windfall elimination provision. Okay, pension based on work not covered by Social Security. So you just want to make sure you click on that so that you're pulling up the appropriate or the correct estimator. The only other piece of information you're going to need to use that calculator as municipal employees is an estimate of what your pension will be, and that's probably easy to obtain online as well. Okay. Next slide, please. It's a great planning tool. So if you haven't already done this, I would encourage you to do this. The first step is set up that My Social Security account. If you already have one, just sign into it, then click on Estimate My Benefit through that portal, and you'll be able to estimate your future benefits, plugging in whatever age you're considering collecting. If you have not yet created an account, when you click on Create an Account, it's going to ask you to select either ID Me or login.gov to authenticate and identify who you are before you can access that information. So be aware. Don't be alarmed if you're brought off SSA.gov. That's going to happen. That's just the way we're going to verify who you are. Because again, it's all for protection of your information, because we don't want to make it so easy that someone that found your Social Security card, which hopefully you're not carrying that, hopefully you're guarding that, safeguarding that in a safe place with all your other important documents like your passport, right? We shouldn't carry our cards around. There's no need, unless you're applying for a job. You really shouldn't be carrying it. But again, it's set up that way to protect your information, because next slide, please. Through that account, when you're still working, what you can do is obtain those estimates, look at your earnings history. But when you become a beneficiary through that same account, it allows you to update your address with us, replace your Medicare card if you lost it, update your phone number, switch your direct deposit, all those, business processes that normally required a phone call or have to visit the office now, just like you do with your banking and other online transactions, you can just log into your account and make those updates very quickly, very safely. Next slide, please. So as I stated earlier, spousal benefits under Social Security, because we talked about how you qualify as a retiree, you at least age 62 and at least 40 credits paid into Social Security. For a spouse, they have to, of course, wait until their spouse is also filing and collecting at the same time, but they have to be eligible for a benefit of their own that's less than half of their spouse's full Social Security benefit. For example, would I qualify for a spousal benefit? No way. I'm working, I'll receive my Social Security benefit, my spouse will receive his. However, let's say I stayed home and I didn't work and I stayed home and raised our kids. Well, when my spouse started collecting Social Security, I could apply for benefits as a spouse. It would allow me to have my own Social Security benefit separate from his, right? And it doesn't reduce his at all. It's an additional benefit. The most a spouse can receive is 50% of the spouse's full benefit. Okay. It's less if I would have taken it early. If I would have taken it at 62, that 50% figure is not what I would receive. It would be reduced by 25% for taking it early. But again, does not reduce a payment to the worker, and sometimes payable even in death cases. And we'll talk about that in the upcoming slides. But again, this was spousal benefits under Social Security were intended for the spouse that did not work and did not have their own income in retirement. Next slide, please. Divorced spouses are also protected under the Social Security Act. However, the difference is they don't have to wait until that former spouse starts collecting benefits to file. As long as both parties are at least age 62 and the duration of marriage is met, a divorced spouse can qualify. Again, have to be at least age 62 and need to be unmarried at the time of application, but have been married for at least 10 years to that individual. How do we find out this information? When you apply, we ask, it's part of the application process. Are you married? Were you married? And the reason behind that is to determine eligibility one way or another. So anyone that submits an application for retirement, if we identify eligibility for spousal benefits, we reach out to them and let them know to contact us to submit these documents that would be necessary in the case of a divorced spouse, because they would have to show us proof of marriage, proof of final divorce. Next slide, please. Excuse me. Survivor benefits. Under the umbrella of Social Security, under that protection of benefits also includes benefits when you lose a loved one. Social Security provides benefits sometimes to eligible spouses, surviving spouses, and sometimes they're eligible children. If there are minor children or even disabled children of the deceased. So unlike spousal benefits, that the beneficiary has to be at least age 62 in order to apply, in order to qualify for survivor benefits or widow's benefits or even widower's benefits, the minimum age is 60. Okay, that is a reduced benefit. If a widow or widower is taking benefits at that age, they're looking to receive 100% of the deceased's Social Security. They would have to be full retirement age themselves. A widow or widower can apply as early as age 50 if they're disabled, but of course that requires a medical determination. This is not needs-based, and this is very comforting for folks that have children to know that they'll be able to receive part of their Social Security for those children that are disabled, for those children that aren't going to be able to support themselves, right? Minor children are eligible for these benefits, just like in life, a minor child, but in death, if you are eligible for a Social Security benefit and you have minor children, they qualify for up to 75% of your Social Security benefit. And if that child is disabled, that benefit continues, and it includes Medicare. So again, very comforting for parents with a disabled child, because we offer benefits for disabled children, but very often if the parents work, when they're minors, we have to look at the parents' income and the parents' resources, and they may not be eligible. Once they turn 18, of course, that doesn't count. But under Social Security, we never look at the child's income, assets, or parents' income or assets to determine eligibility. So again, very, very, very important to know that, because there's always someone in the audience that has a child in a situation like this. Next slide, please. Survivors, the last thing I want to say about that is that they are the only beneficiaries that have the option of switching from one benefit to another. Anyone receiving is eligible for benefits as a widow or a widower, they have the option of then switching to their own Social Security benefit at a later date if it's to their advantage. Because remember, as I stated in the earlier slide, when we delay or put off collecting our Social Security benefit, it grows, right? Because when it's increasing. So someone, if they're eligible, could take benefits, if it's again to their advantage, to take benefits as a survivor, then they could switch to their own at a later date. We do these computations. Anyone that's eligible based on a deceased spouse, we encourage you to contact us, because that application is not yet available on our website. And when you do contact us, we can talk about these options. If the surviving spouse does have a work history themselves, we can talk about how they can take benefits at one point and then switch to the other. And even if they don't remember, we have a work group in our payment centers that looks at all the widows and widowers receiving benefits, and they look at determining whether they could now benefit by switching to their own and receive a higher benefit. And if so, we send them correspondence asking them to contact us to file that additional application. Next slide, please. So again, just a side-by-side comparison of spousal benefits in life versus surviving spouses. In life, earliest age 62, but death benefits or survivor benefits can be payable as early as age 60, 50 if disabled. Living spouse, the maximum that they can be eligible for at full retirement age is 50% of the spouse's Social Security benefit. Widowers benefits, the minimum 71.5% if they take it at age 60. It would be 100% if they start collecting at full retirement age or later. Next slide, please. So again, I did touch upon this about the benefits for children, minor children eligible up until age 18, 19 if they're in high school. And when a child is approaching age 18, the person responsible for those benefits will receive a letter from Social Security letting them know the benefits are going to terminate, but that they can continue if that child has a disability, in which case they would have to recontact us to submit a medical application to determine continued eligibility. Next slide, please. So the windfall elimination provision, this came out as part of the 83 amendments when the Social Security Trust Fund was in trouble, and they had to make changes to ensure solvency, to ensure payments for future generations. Because back in 1935, when Social Security was first written into law, a retiree average lifespan was 10 years. Now a retiree, it's not unusual for a retiree to live 30, 40 years in retirement. We have so many centenarians that are receiving Social Security benefits much longer than was ever anticipated when this benefit was first enacted. One of the many changes was an evaluation of benefits. So our formula is a weighted formula. And so when they were examining benefits and beneficiaries, what they were receiving at the time, they found that individuals that worked in non-covered employment, filed for Social Security, they had the minimum 10 years, were receiving a higher percentage of a benefit as though they were lower wage earners, when in fact they were not. It's just they were paying into non-covered systems such as yours, right? It's not that they weren't working, but they were paying into alternative pensions, but not paying into FICA. So this provision causes Social Security to use a different or alternative formula to calculate your benefit because you didn't pay in the 35 years into our system. So it modifies your amount, never eliminates it. It never wipes it to zero. So that's an important thing to note, because a lot of people have misconceptions about this. But again, this came out in the 83 amendments. Another change that was made is children's benefits. Before the 83 amendments, children that were eligible for Social Security because a parent was retired or a parent was deceased, they used to collect through college or at age 22. Some of you may have that are listening, right? Some of you may have lost a parent and said, yeah, I collected Social Security through college, but they changed that. They brought it back to they brought it to age 18 as part of the 83 amendments. Next slide, please. Now, who is affected by this? It's when you're receiving or qualify for Social Security and a non-covered pension, right? Now, some of you, as I stated earlier in the presentation, this might be a second career for you. So some of you are probably thinking, well, I paid into Social Security for quite some time. I've only been, working with the municipality for a short time. I'm going to be eligible for a minimum pension through the town. So the formula we use will differ. The more years of contributions you have under Social Security, the higher percentage you're going to qualify for. And some of you may even be exempt from this provision. Next slide, please. If you have 30 years or more of substantial earnings paid into Social Security, and substantial may not be as much as you even think. In the upcoming slide, I'm going to show you what that looks like. But if you have 30 years or more of substantial earnings, we don't reduce your benefit at all. We use the regular formula, just like it will be used when I apply for Social Security. If you have 25 years of substantial earnings or better, you're going to be receiving upwards of 65% of your Social Security benefit. And again, in your particular case, because everyone's work history, everyone's case is different. This is why you want to use our estimator online. And again, make sure you choose the one that says windfall elimination provision, so that in your particular circumstance, you can see how much you're going to qualify for. Next slide, please. This slide shows you, and this is also available on our website, how much you need to earn for it to be considered a year of substantial earnings, right? So that you can hopefully be exempt from that formula and receive your full Social Security. So for example, like in the year 2000, you earned $14,175. That would count as a year of substantial earnings. So for some of you that are listening, and you're that person that this is the second career for you, and most of your working life you did pay into Social Security, well, then you want to look at your statement later and you want to review this slide. And again, you can access this on our webpage too. If you go on to ssa.gov, under publications, there's the windfall elimination fact sheet, and this is pulled right from there. And if you have 30 years or more at these levels, no reduction, you will be eligible for your full Social Security benefit. Okay, the windfall elimination provision will not apply to you. Okay, next slide, please. So the government pension offset was another provision or another law that came out of the 83 amendments. And remember, as I stated earlier, spousal benefits under the Social Security program were intended for the spouse that did not work outside the home, or did not earn much if they worked outside the home, to allow them protection, to allow them their own benefit in retirement. Because of that, if you are a municipal employee, if you are a state employee and you did work and you have a pension, well, then we have to use a different formula to calculate that technical spousal benefit that you may or may not qualify for, because you worked, because you have your own benefit, right? Because you did contribute into a retirement system. Government pension offset, that formula is a little bit easier to compute. You don't even need the calculator, although we have one online if you would rather use it. But basically, again, if technically you're eligible, so say you don't have 40 credits, and technically you would be eligible for half of your spouse's benefit. But because you did work and you have a pension, the government pension offset, the way that works is we have to reduce. Next slide, please, just so I can illustrate this. Thank you. This slide shows you how the government pension calculation works. So that 50% that a spouse would potentially be eligible for, if they're eligible for a non-covered pension, we have to take 2/3 of that amount of their pension and reduce it against the spousal benefit. This is when sometimes you can have people say, well, I'm not eligible for anything from Social Security. And that's because they don't have 40 credits of their own, right? But they were thinking, oh, I'll collect on my spouse, or I'll collect on my ex-spouse, or I'll qualify on my deceased spouse. Well, perhaps not if someone's had a career and has a significant pension. Because remember, the spousal benefits under Social Security were to provide a benefit for that spouse that didn't work, didn't have income of their own. So again, this is just an example of someone that has a pension, $1,200, and potential benefit under Social Security. We have to reduce it by 2/3 of the amount. So 2/3 of 1,200 is 800. So they would have been eligible for 750, but the 2/3 of their pension wipes out the spousal benefit, okay? Now, for some people that are working for the town, maybe have very small pensions, right? Like some of the cafeteria workers or some of the other positions that don't have significant pensions. Well, there might be a spousal or partial spousal benefit payable. But for individuals like teachers, for example, that are receiving pensions of $2, $3, sometimes more, $1,000 a month, 2/3 is going to wipe out the Social Security benefit. Social Security doesn't even pay benefits for spouses for $3,000, $4,000. Okay. Next slide, please. So again, just this another side-by-side comparison because people get these two provisions confused all the time. The WEP, or the windfall elimination provision, applies to your Social Security benefit. That's the formula, the modified formula we have to use. If you have 40 credits paid into Social Security, but also worked in non-covered employment, the WEP applies to you. GPO, or the government pension offset, that applies when you're receiving a non-covered pension and now applying for benefits as a spouse or a widow or a widower, okay? Under the WEP, your benefits will never be reduced to zero. Under the government pension offset, it could be reduced to zero. Next slide, please. Taxes. Some of you are probably thinking, well, will these benefits be taxable? Well, almost everything is taxable, unfortunately. We will not withhold any federal tax from your checks unless you ask us to. You can submit a W-4 and have a percentage of federal income tax withheld from your benefits if you choose. If you do not, we will not. But you will receive a 1099 every year. And if you have other income, and if you have income between 25 and 34,000, okay, that's total income, you might have to pay tax on up to half of what you received from Social Security. If you're married, filing jointly, if you had income between 32 and 44,000, you might have to pay income tax on up to 50% of what you received from Social Security. You can find more details about taxation, because this is all I know about taxes, on the IRS website. Or, of course, you can always talk to your accountant or whoever it is that files your income taxes for you. They can go into some more detail about that. If you choose, you can have a percentage withheld. Just when you apply, you can say, I want 7% or 5% withheld for federal income tax. If you do that later, you didn't do it at the time of application, you can just go to irs.gov, or it's even on our page, you can download that W-4 and submit it to us. So when it's time to apply, how do you do that? Well, you have options. Easily, most quick and efficient way to apply these days is online. Go to ssa.gov. Almost 24 hours a day, you can go onto our webpage, click on apply. You can apply for retirement benefits, spousal benefits, disability, even Medicare only. We just added SSI as well, which is our needs-based benefit, onto our website. 10-15 minutes maximum, very easy. Yes, no answers. The only pieces of information maybe you have to look up if you don't know your spouse's Social Security number, your bank's routing number and your account number, because direct deposit of our benefits, probably just like your pensions and your pay stubs right now, your paychecks, direct deposit is a must. And it's actually the safest way to receive your benefits. But if you're not online, or if you're not comfortable for whatever reason submitting your application online, you can call us. You can call our 1-800 number and ask for an appointment, okay, over the phone. These days is what most offices are doing, because unfortunately COVID is still here. So some offices, depending on their situation, are just doing phone appointments. Others might be able to schedule an in-office appointment depending where you are, depending on that office's situation. But again, you can apply either online or on the phone or in the office. The offices are open. We opened back up in last April. So you can just walk in. But again, most offices do prefer you have an appointment, and it's probably better so that you can minimize your wait in the waiting room. Next slide, please. Our webpage looks like this now. It had a little refresh, making it a little easier to navigate. The prepare page is where you'll find the links to the My Social Security account, so that you can estimate your benefits, review all your earnings, your potential eligibility. When you're ready to apply, you click on the apply benefit, which brings you to all the online applications that are available. One other tidbit I wanted to share too, that under the My Social Security account, the newest service that they added to that was replacing your Social Security card. So if anyone lost their card and maybe they're trying to get the real ID, and if you don't have certain documents, sometimes they ask, the R&B asks for a Social Security card. They don't take the laminated ones either. So if you or your loved ones carry one of those, they won't accept it. So if you need to replace it, again, you can very easily go online through your My Social Security account. That's one of the many things you can do, is request a replacement card. And it takes just as long to receive in the mail as if you went to the office, with a lot less hassle. Next slide, please. So Medicare, this is a very important piece. Medicare eligibility age remains 65. That has not changed. Even though they increased the full retirement age, they didn't touch Medicare eligibility. Some folks will qualify at a younger age, but that's if they're receiving disability benefits. So someone that's receiving disability under Social Security, they would qualify and be enrolled in Medicare automatically after a 2-year or 24-month waiting period. But as retirees, we're going to enroll in Medicare at 65. We have the first chance, or our initial enrollment period is 3 months before and up to 3 months after our birthday. So if you're retired, no longer working and covered through the active plan through your employer, you will need to enroll in Medicare 3 months before your birthday, so that your Part A and your Part B will be effective as of the first day of the month of your 65th birthday. What happens? You enroll in Medicare, you let your town know, you show them your Medicare card, say I'm signed up, or I'm enrolled, or you can even show them the letter that you'll receive from Social Security that states we've processed your application, and it'll show your Medicare eligibility dates to Part A and Part B. And then they will make the change with your town insurance, making it your secondary insurance, so that together you have complete coverage. Okay. Now, what if you're 65, but you're still working and you don't have plans of retiring? That's fine. You don't have to enroll in Medicare if you're still working and actively covered through the active plan. But when you do retire, you sign up during a special enrollment period. We give you an 8-month window, or Medicare gives you an 8-month window to enroll from 8 months from when you walked out the door, or your insurance coverage ended, your active insurance coverage ended, whichever comes first. Now, again, the town, it's a law. When you retire, if you're 65 or over, you must enroll in Medicare. So they're not going to want you to wait the 8 months, even though the law says you can, but they're going to want you enroll when you retire. Actually, you can even start the process of enrollment a couple of months before your anticipated retirement. Now, there's no penalty when you're signing up later, because you were working and covered through an employer group plan. During a special enrollment, there are 2 forms that would need to be submitted. You can access those on our webpage, or you can, if you don't have a printer at home or don't have access, we can mail you the forms. One is the form that you tell us what month you want your Medicare effective. The other form you have to take to your HR, to your HR department, to answer a few questions, to prove that to us that you were working and you were covered through the active plan. This way, there's no late enrollment penalty, which you've probably heard about, right? Some people are paying more for their Medicare because they didn't sign up when they should have. It's insurance, just like every other, right? That has penalties and, late charges like.
So Delia, just curious, is it a recommendation that regardless of your working status, you should be signing up for at least Part A upon turning 65?
You don't have to, you won't use it as a town employee or even as a state employee, you won't use it. Because Medicare only becomes your primary when you have Part A and Part B. And now a lot of insurance companies, a lot of even towns and state are moving into these HSA plans. And then there's rules. IRS says you can't have an HSA and be enrolled in Medicare, even if you don't use it, because we've had people yell and call us and say, oh, I get this penalty from IRS because I signed up for Part A and I still have my insurance through work. Again, it's not our rule, but the IRS is the one that sets these rules about HSA. You can find information about that if you go onto IRS's website. There's a whole page dedicated to HSAs. So in a situation like in Massachusetts, with municipal employees, town employees, you don't have to. You can just sign up for A and B at the same time when you retire, if you're retiring after age 65.
So the HR department comes into play if they need to prove that they were covered by a town health insurance plan so they don't get penalized.
Correct. That's when they're enrolling post age 65. So someone retires from Needham at 67. Now they're enrolling in Medicare. They have to submit those 2 extra forms. Whereas when you apply before your 65th birthday, it's not necessary. But when you're applying after age 65, to avoid the penalty, you have to prove by those forms that you were working, and that's why you didn't enroll in Medicare, because you had insurance through your town. And this way you say, okay, well, what month do you want us to enroll you? No penalty as long as we get those forms completed. So that's where HR comes in.
Thank you.
So for someone that didn't sign up during your initial enrollment period, maybe forgot to sign up during a special enrollment period, the last chance to enroll in Medicare is during the general enrollment period, which we're in right now. And it runs from January 1st through March 31st. The Biden administration did change this enrollment. It used to be that there was a huge gap for people that signed up during the general enrollment period. The Part B would only be effective in July. On top of the penalty for late enrollment, there was a huge gap. But now they changed that. Yes, there's still a late enrollment because you didn't pick it up when you should have. But at least now we can make the Part B effective the month after you ask us to, instead of 7 months later. So that's a big and a very significant change to the general enrollment period. Next slide, please. So with Medicare, Medicare has Part A and Part B, the hospital insurance, Part B, the medical insurance. Just like it sounds, Part A covers you for inpatient hospital. It's free as long as you have 40 credits or if paid into Medicare for at least 10 years, which municipal employees, town employees, state employees do. Anyone hired in the 80s. Prior to that, they did not. Part B, everyone pays for Medicare, Part B. It has a monthly premium, and that is your medical insurance, the part you'll use the most, quite honestly. That covers you for your outpatient care, your doctor's visits, blood work, PT, tests, ER visits. That all gets billed under Part B. But it only covers, Part B only covers 80%. So if I were giving this seminar to the general public, I would say, well, and then you have to shop around for an insurance to either supplement your Medicare, right? To cover that 20% that Medicare does not, to cover the deductible with Part A, right? Because every insurance has deductibles, to supplement your Medicare so that together you have complete coverage. Or you can replace your Medicare with a Medicare Advantage plan, also known as a Part C plan, right? You're fortunate in that as town employees, when you retire, you have the ability to carry your insurance into retirement. The premium will go down because now you're going to pay for Part B of Medicare, because Medicare is going to be your primary, or Medicare is going to pay first, and your town insurance will pay second. But the plans you have through your towns are enhanced plans. They include prescription coverage, and they're less expensive than what you would buy in the open market, right? If you were a private sector employee looking to supplement your Medicare, it would cost you more. So again, that's a benefit. So, and you have just a few plans to choose from. Whereas if you were just someone that worked in the private sector looking to either supplement your Medicare with a Medigap plan or a Medex plan, or replace your Medicare with a Part C plan, you have so many choices. It's almost overwhelming. I tell people they can either go on Medicare.gov to find information about the best plan for them or the best plan they can afford. Read through the pamphlets and flyers they're going to receive in the mail, attend some of those seminars and talk to those reps and ask the necessary questions, or make an appointment with your Shine counselor, which they work at your senior centers, and they are well-versed and educated in all these plans, and they help people decide which plan will work best for them, which plan will serve them well, depending on what their healthcare needs are and sometimes what they can afford. But again, you'll have just a few plans to choose from, so making it less confusing for you. And again, your HR department, when it comes time, they can help you with those choices, right? You just have to remember when you're retired that you sign up for Part A and for Part B of Medicare. Even if you don't want to take the cash benefits at the same time, if you're eligible, but make sure when you're retired, if you're approaching age 65, that you sign up for the Part A and the Part B. Next slide, please. So again, these are the two forms that I mentioned for the people that are signing up after age 65. Those two forms can be accessed on our webpage. They're the ones highlighted in blue. When you click on apply for Medicare or click on Medicare, it brings you to those links. Now you can even submit them to us electronically, which is great. They made that happen during COVID when the offices were closed, and people could only send them in via snail mail. Very quickly, they added the feature that people could send us these forms electronically, which was great because, you know, health insurance is nothing we can't be without it, right? So it's comforting to know that you have options, right? Yes, you can snail mail them or drop them off at the office, but you can also upload them and send them to us electronically through ssa.gov if you're enrolling after age 65. So costs, you're probably by now thinking, well, what does that Medicare cost? Well, for this year, surprisingly, the Medicare premium actually decreased by about $5. Beneficiaries received a huge cost of living adjustment, over 8%, and the Medicare went down, which was unheard of, right? And it's a win-win for Social Security beneficiaries and retirees. So this year, for someone enrolling in Part A and B of Medicare, Part B will cost $164.90. How do you pay for it? Well, if you're receiving a check from us, if you're receiving a retirement check, that premium will be automatically deducted from your Social Security check. If you're not, if you maybe you're just taking the A and B of Medicare for now, maybe you're going to delay, maybe you want to utilize those strategies to get more and put off collecting your Social Security, Medicare will bill you quarterly for that premium. So I said standard premium, right? That's what most people pay. But you know, Medicare is subsidized by the federal government. And again, because the Medicare fund was also in trouble, just like the regular trust fund was, when they evaluated the fund, it was decided that some folks in a higher income bracket would receive less of a subsidy from the federal government and thus have to pay a little bit more for their Medicare. And again, most people do not. Most people pay the standard. But if you are an individual and you have modified adjusted gross income over 97,000, and that's as reported by the IRS to Medicare, you might pay an additional $65.90 on top of that standard premium and an extra $12.20 for the prescription coverage.
And I just want to make a clarification because we get this question a lot. This is separate from what you will be paying for your Medicare supplemental plan to the town. So
Correct.
this is these amounts you do pay to Medicare on a monthly basis.
Correct.
In addition to what you might be getting deducted from your pension check that comes from the town to cover your supplemental.
Correct. Absolutely correct.
Delia, I just want to make sure we have enough time to do questions. I know you have a few more slides, but I'm hoping that we can get through those quickly.
Okay, we can move on. Again, this does not apply to most people, but this slide is available and this publication is on our website if you want more details about that. It's on Medicare's website. It's also on ours as well. Next slide. Again, this is more for the general public that needs to shop around for plans. So, but you'll still use the Medicare website because you might have questions about coverage. Will my Medicare pay for this device? Will my Medicare pay for this surgery? So you'll want to be familiar with the Medicare website. We do offer an assistance program for people that have lower income. So again, just an FYI, it might not be for you, but maybe someone that you know, that this application can also be filed on our website, and it helps people on average save about $5,000 a year. So I just wanted to throw that in there as an FYI. Next slide, please. And again, just to keep up with the latest and most up-to-date information, we're also on social media, so follow us on whatever platform that you use so you can always be in the know. And now,
you guys have Instagram?
yeah, we're even on Instagram. Yeah, like the cool kids, we're on Instagram.
Snapchat, they have Snapchat too.
Yeah, we don't have Snapchat yet. Excuse me.
Well, thank you for that, Delia. I just want to give people a chance to ask questions. And first is Liz. Go ahead, Liz.
Can you hear me?
Yes.
So I worked in the private sector for 12 years at Mercer, and we were a third-party benefit administrator. And I worked with retirees all the time, and they had questions like, well, I was collecting my husband's, and now that it's time for me to collect, they gave me the impression that they had to, go to her own. I mean, is it either or? Did she choose not to collect her, or did she has to go to her own and can't no longer collect her husband's, like, or her deceased husband?
If you, deceased. Remember I said earlier, the widows or widowers are the only beneficiaries that have the ability to say, I'll take one or the other and can switch. But in life, if you're eligible for a Social Security benefit of your own, you have to take it. And if you're eligible for a spousal benefit in life, you take that at the same time. You can't say, oh, no, I'm just going to take a spousal benefit and let mine defer. No, you can't do that.
So,
but a widow or a widower can.
and so she's like, okay, because my husband made, I mean, it's just, if their husband made way more money, it's just, but they were told, oh, no, now I can't take his, this is like 15 years ago. So I was just wondering now it's either or if you were collecting your deceased husband.
It's always been for the widows, it's always been that they can take whichever one is to their advantage. And remember, so say I was collecting benefits at age 60, I could then at 67 switch to my own if I worked, if it was better for me. But if it's not, I would just stay on my deceased husband's.
Okay, that was the question I had.
Okay.
All right, thank you. Next up is Kay Ellen.
Okay, my question is this. Will have worked for the town for 50 years at age 65. I have not paid a single dime into Social Security.
Okay,
I do?
you don't have to do anything. Uh, You don't have to do anything. But are you paying, so 50 years, so you might not even be paying into Medicare, are you?
No, I paid
Yeah.
nothing.
Yeah. Are you married?
No,
Never?
never.
Smart girl. Well, if you were, then you could apply for Medicare on a spouse, right? Because there are
Yeah.
many ways we can enroll someone in Medicare. But in your case, the town will want you, when you retire, to contact us to submit an application and get a determination that you're not eligible for the free Part A of Medicare. Because if you've been working for the town for over 50 years, you probably didn't pay that 1.4 into Medicare.
The option was never given to us at the library when the rules changed in '83. So
Oh,
I am the last of the
to
hanger
the
on. So to
Mohicans.
speak.
Yeah, yeah, there aren't many of you out there. There
No.
aren't many of you out there. So the town doesn't drop you. They'll keep you. You'll contact us, submit an application, and we'll say, you're not eligible for the free Part A. Anybody can buy Part B. But the insurance through the town doesn't work unless you have A and B. And unless the town changes their rules that says, sign up, we'll pay for the Part A, because you can buy Part A. It's just very expensive. Some towns, just as an FYI, some towns have made the decision for folks like you to pay the premium for Part A. You know, and say, hey, we want you to enroll in Part A and B of Medicare. We'll pay the penalty, we'll pay the Part A premium. You would just have to pay the Part B. But I don't know if Needham has done that. I don't think Needham has made that decision.
Not that I'm aware of. I mean, we do have plans that are non-Medicare that, you know, people can remain on.
Yep.
We have at least one case, I believe, of a person who is not eligible for Medicare, so they remain on an active plan even past the age 65.
Yeah. So don't worry.
So I will be talking to
It's happening.
HR when I eventually retire. Okay.
Yes. All right, let's see. Who else is next? Sean.
Hello, hi Delia, hi Tatiana.
Hi.
Question, Delia, I received a statement from Social Security that has my benefits listed. Is
Okay.
that with the windfall elimination tax? So that's just the benefit?
Yeah. That's if you have had no non-covered pension, because we don't know for sure if you're eligible. So
Okay.
you want to go into our website and use the windfall elimination provision calculator.
Okay,
So if you have 40 credits, if you see a dollar amount, that's a good thing. That means you have at least 40 credits, probably more, hopefully more.
Mhm.
So you're eligible for something. And if you want to see what that amount will be in your particular case, I would recommend you use the online calculator, making sure you use the windfall elimination provision one.
great. Thank you very much. Thank you both.
You're welcome.
I received a last minute question I'm hoping I can ask. It's on behalf of one of our firefighters. They want to know, they will be getting, you know, their town's retirement upon retirement, the town's pension, but they did work 40 work credits on a side job. Will I still get my full Social Security benefits?
Okay, if I'm understanding that question correctly, if they have, they're saying they have their full 40 credits. So 40 credits is only 10 years of work under Social Security.
Yeah.
To their full benefit under Social Security, unaffected by the windfall elimination provision, they'd have to have 30 years or more of substantial earnings. Remember that slide that showed every year and what we distinguish as a year of substantial earnings? So those side jobs, they'd have to check off and see, do I meet or, you know, exceed that amount for 30 years? If that does not apply, then there is the windfall elimination provision. Hopefully, you know, it's not as much as if someone that just has the minimum paid in, if they have, you know, 22 or 23 years paid in, they'll be eligible for a higher percentage than someone that just has the minimum paid in.
Which will be a reduced benefit, correct? So it will be like most of us that have maybe all of our, minimum 40 credits that have worked for the town most of our lives.
Right,
And whose main source of income upon retirement is going to be the pension.
right. Correct.
Okay, let's see, Hank.
Hi, Hank.
Unmute. How are you? Thank you for this. This has been very helpful.
Good.
The question I have is, if both spouses are working, one spouse turns 70, in other words, eligible for the full amount. The other spouse doesn't turn 70 for another 11 months. Can the other spouse take 50% of the first spouse's Social Security while waiting then those 11 months until the second spouse turns 70 to get their full amount?
No, if you're eligible for a benefit on your own, you can't choose to take a spousal only if you're a widower would you be able to take one benefit versus your own.
I see.
But in life, if you're eligible for a Social Security benefit and perhaps a partial spousal, you have to take both at the same time. You can't defer one and then take the other later.
I see. Okay, thank you.
All right, next up is, oh, I lost her, but Teddy was next. Okay, Kim, you're up.
Hi, Kim.
Hello, can you hear me?
Mhm.
Okay. I was having issues with my headset earlier, so that's why I'm asking.
Mhm.
This is gonna, well, it's probably not a weird question for you, but so both my husband and I work for the town or different towns now. We originally started in here, but he now works for another town, which not that matters. We both have 30 years of previous private work, work life.
30
And now-
years substantial?
Yes, I think, because on my Social Security statement, the
That's your
last one I
homework.
have,
That's your homework. You have to check it.
well, so on my statement, because I get one every couple of months, actually, it has, it lumps like 1991 to 2001 as one full amount. So
Yeah.
I don't know how to look and see what those years were to compare them on that.
Yeah, with the new statement, they did that. I don't like that they did that, where it used to break down every year. If you
Yeah.
think you're close to the 30, you can give us a call. Call the 1-800 number and they can check that for you.
Yeah, because for the first, so they have I have
Or you
two-
can call your local office, whichever one has the shortest hold. And say, my husband and they're not going to tell you anything about your husband unless he's with you.
Right.
But on yours, they could say, yep, they're not going to say it right away because they're going to have to pull up that chart themselves
Right, yeah.
and to determine if you have the 30 years, and hopefully you do. Wouldn't that be great?
Well, so I can look on previous ones because I get them. Well, obviously you got them every year previous to that, but now that they're online, I get them
You
more
know what?
frequently.
If you have the old ones, the older ones broke it down for every year.
Yeah.
So
Okay,
you can just look at that chart from the PowerPoint, which Tatiana can share it with all of you if you want. Or you can also get it from our website on that publication. So take the old statement and you can check off. So like 2000 was 14,000, I think 175. If you made 15, boom, that's 1 year. And then just keep, you know what I mean? Go back, of course.
yeah, no, I'm good for all the ones that are listed individually. It's just the ones that are lumped that I just can't
Oh,
figure out if they were in the right range for that specific year.
yeah.
You know what I mean? But anyways, regardless of that, so I have the 30, I have the thing. I unfortunately will not retire until I'm probably dead, but let's hope it's at 67. So that's another 20 years or so that I'll be doing. So I'll get the pension and then I'll get the Social Security benefit, whether it windfall or not. But my actual question is, I am in an HSA plan right now, a high deductible plan, and have an HSA account. It caught my attention earlier. You said that you couldn't have an HSA account once you have Medicare.
You can, right. You can't
So-
contribute into the HSA.
No, but I'll still be able to use the money that I put into it, because I was planning on using it for
Yeah.
payments of medical stuff
course.
afterwards with
Of
it.
course, it's, you can't. And I don't know why, but the IRS has rules about contributions. The year you turn 65, and again, you can.
So I just can't keep adding to it after 65, but up until 65, I can add to it because it does have an option
Oh,
to,
absolutely.
if you,
People love their HSAs.
yeah,
Wait,
because if
actually,
you put enough money into it, you can roll over some of it into like, almost like another,
IRA, right?
yeah, like an IRA type thing to supplement the other IRA that I have. I
Yeah.
was gonna take some of that, supplemental money that I'm not using right now and
Yeah.
do that, but I didn't know if I couldn't have the HSA, like, I just didn't know what to do with that account before then, I guess that
Yeah.
was my question.
All I'm allowed and all I know about it is that IRS has rules about contributions the year, once you turn 65. More details, go on to irs.gov and click on the search button for HSAs, and you'll see all the language and all their rules about them.
Delia,
Okay,
do you
so-
know if a person is still working after 65 and they have an HSA plan, is that okay?
Sorry, say that again?
If a person is still working after 65, are they okay to continue to contribute to an HSA plan?
I
Or are
don't
we-
think so.
Nope, we're supposed to cut them off at that point.
Again, I would refer you
We'll
to.
do some research. All
Yeah,
right,
yeah.
thank
Yeah,
you.
let me know.
It's not Social Security's rule, it's not Medicare's rule. This is, I have working knowledge because again, I do seminars for private companies. Every town in Massachusetts. And this is something that's come up that has caused us to do research. Like, what is this rule? Because we've had people that would sign up, take Part A, keep working, stay on their employer plan. Over years, more and more companies are moving to high deductible insurance plans and offering HSAs. So we in public affairs and our offices have been doing research and saying, well, what's IRS saying about this? So, and again, they're a separate agency.
Yep.
All I know is take caution with HSAs when Medicare time comes. And I just advise people read up on IRS's website and talk to your HR department so that, you don't find yourself in a situation.
Okay, thank you.
Thanks, Kim. All right, Rob Giamatti's up next. Hi, Rob.
Hi there. Thank you guys for doing this. So I have many years before retirement, but I have 19 substantial earnings years towards a windfall elimination provision. I just recently quit my second job, so now my Social Security income has gone way down. My question to you is, I've heard rumors of the windfall elimination provision maybe not existing anymore down the road. Is this something that you see in the future, or is it something that I should continue to pay into Social Security, quarterly so that I can continue my substantial years?
If I only had a crystal ball.
Right.
I've been hearing about, the advocates that have been fighting to repeal it or adjust it or eliminate the windfall elimination provision. I've been hearing this since the 80s.
Okay.
And I haven't seen anything to date, and I've been doing this job for a long time.
Yeah.
So
So
my advice is do what's best for you.
yeah. So it is probably personal preference, but you would probably suggest keep paying in so I get those years. If I'm right on the border as well, I'm right under.
I mean, if
1 year.
you want to maximize what you can receive from the Social
Yeah.
Security end.
Okay. All right. Well, thank you very much. Appreciate it.
Of course, I'm happy I had this opportunity to talk with all of you today.
All right, let's see, Teddy Eaton and Teddy, I have Teddy and Jessica, and then we'll have to move on to retirement. So, all right, Teddy.
Hi, I'm sorry, I just came in late.
No problem.
Can you just tell me I've worked for the town a long time and would have very little Social Security income after I retire. And I know I would receive a retirement benefit from the town of Needham. But would I also lose my husband's Social Security?
We would offset it once you're eligible for your pension.
Yes,
2/3, we'd have to reduce your spousal benefit by 2/3 of the amount of your pension.
that's sad.
Yeah, because it's a dependent benefit. You know, it's a dependent benefit because you worked and you have an income of your own. That's the reasoning behind it.
Yes. Is that in all states?
Not all states, so not all states made the decision to not contribute into Social Security. But
Yeah.
you, so regardless of the state you lived in, so say you lived in Idaho and worked, you still wouldn't have a spousal benefit because you worked all your life. Just like I'm never gonna have a spousal benefit, you know what I mean?
Yeah. Okay, I thank you. That's all I
And-
wanted to
and
know at
and
this point.
I try to explain it that way so that people understand, and because I think there's sometimes a little upset and anger over it, but I think people just don't understand the meaning or the reasoning behind what spousal benefits are under Social Security.
Okay. Well, I thank you.
Thanks, Teddy. And then last is Jessica.
Just one quick question. I'm just curious, what, is there a set amount that's considered as a substantial year?
There is, on that slide. for
Yeah, I
every-
missed the
for-
amount, sorry.
Yeah, for every year. Yeah, if you reach out to Tatiana, she can email you this PowerPoint if you want, or you can pull up that publication that breaks down all those earnings on our website. You click on publications and then do a search, windfall elimination provision. On the
Yep.
flip side of it, it has the chart.
The
And-
chart of what the
Yeah,
amounts
it
are.
it has 2022 amount on there as well.
Perfect. Thank you.
Thanks, Jessica. And I just wanted to clarify, Liz, you already asked your question. Just want to make sure that we don't need to.
Well, I had another one, that's all.
Oh, you did? Okay, go ahead, Liz.
I know, actually was a question was just, I think the question about the Medicare and the HSA and all that, I think that maybe she's confused. If you're still working, you don't have to apply for Medicare and whether you're 65 or not. And so if you're not on Medicare, then you can still have the HSA.
Right.
That's all.
It's when you approach age 65. If you're still working, there are rules about contributions into HSAs.
Yeah, because I have a thing that says, if you're on Medicare, then you can't do all those things. So I think that was just, I was just
I believe
clarifying.
there's something even, again, do your homework.
Yeah.
Yeah. We'll look into that because we do have a number of employees that are over 65 and potentially on HSA.
Yeah.
Okay,
that's the
so if
new-
that's all the questions. Delia, I want to thank you so much for being here with us. I'm sorry we took so much of your day, but this is super helpful. As you can tell, it's a very popular subject for us. So
Good.
we thank you so much for being here with us.
I'm happy to have had the opportunity to speak with all of you. And if you want to do this again next year, there may have been folks that couldn't join today. Let's get together once a year, right? Is that
I'm gonna hold you to that because I know we're gonna get a lot of interest again. So
good? Retirement is an important time in our life, and if you have Social Security in the mix, there are a lot of these were all great questions, all important questions. So I'm happy to meet again next year if you want.
thank you, Delia.
Take
All right,
care.
everyone. Bye. Up next is Jacob Cole. He is our retirement administrator. Jake, are you here and can you hear us?
I am here. I'm not sure why my camera is not working.
We can hear you fine. We can't see you, but we can.
Okay, and I actually just want to share the screen, but I'll be really quick as well. Obviously, Delia covered everything Social Security related, and I also wanted people to be able to have the ability to ask her questions. She's authority on things Social Security.
Jacob, we're losing you on the audio.
Okay. All right, let's see. Can you hear me now, Tatiana?
It's low, but we can.
Tatiana, can you hear me right now?
Yes, it's low, but we can.
I can't hear you for some reason. I wonder if I should sign
Oh, you can certainly try, if you want to log off and log back in.
I can't hear you. I can't hear you.
Okay, do you
I'm
want
gonna
to,
sign back in real quick.
sounds good. Well, in the meantime, if anyone has a question regarding benefits in retirement, I can take those. And just to, yes, Angel. I didn't mean for you guys to take me up on it, but hi, Angel.
How are you?
Good, how are you?
Okay, I just have a question.
Mhm.
I'm maxing out at 66 and 8 months, okay? So I guess I'm gonna get my social security in full,
Yeah.
correct? It's on-
Well, it sounds
that's
like it depends on the number of credits you have with Social Security.
Yeah, I got the max. So my eligibility is 68 and 8 months that I feel I go into full retirement because I worked for many years on the private sector. But my question is, if I keep working for a year or two and make 75,000 supposedly, even though my cap is 56, can I put 30,000 into the 457 plan and still work full time?
I wonder if Chuck is on, I wonder if someone from Treasury is online. There is a cap on how much you can put into the deferred comp plan. I don't have the form right in front of me.
Yeah, okay, I understand.
Yeah, but there is a cap. There is there is a cap. I just don't know what the amount is.
Okay,
You should, yeah, we can talk more about this.
we could look into it in another time. I just wanted to
Another time,
ask you
yeah.
that question.
Yeah, I do know there's a cap for how much you can put into it. Like you can't put your entire salary in it. You know what I mean? So
Oh, okay, at least part of it, like, let's say, even though my cap is 56,000 from what I was talking to the lady
mhm.
was quoting, but then if I happen to make 75,000, can I put the rest into the 457? I guess, and still keep working full time.
Yeah, without seeing the form, I can't answer that.
But no problem. That could be for some other
Come and
day.
see me.
Huh? Where's Amy?
Come and see me. We'll go through it.
Okay, sounds like a plan, maybe I'll stop by sometime this week or next week and we could
Okay.
discuss it more maybe.
Sounds good. Thank
Okay.
you.
Well, thank you, Tatiana.
Bye.
Bye.
Okay, Sean, hi.
Hi, Tatiana. Question about A, B, or C retirements. How much does the B go down every year that you're retired? Is there a set number? Is it a percentage of how much you have in that fund?
Are you
Let's say you have $100,000 into it. Every year that goes by if you take Plan B, is there a set amount that comes out of that? 'Cause-
Oh, I see. You're talking about the retirement options?
Correct. On
Okay,
on
well,
B.
Jake is here.
Okay.
Yes, I would say, so let's see if Jake is ready to talk to us about that. By the way, I said benefits, I meant like dental, vision.
Oh, okay, I'm sorry.
No, but I can go. So let's see, Jake.
Yes, can you hear me now, Tatiana?
Yeah, I think we can make it work with your audio.
Okay.
Yeah, I'm not sure what happened really, but
Okay, let me just pull up what you sent me and just let me know when you want me to change the page, okay?
sure. Are you able to? Yeah, that's fine. It's just that when I scroll around it might help a little bit. Are you able to share the screen with me?
Yeah, actually, I just figured how to do that. Do you have that?
Let's see. You can control Tatiana's screen. Okay.
I figured out kind of late for Delia, but I got it for you.
All right, let's see. Says you can control Tatiana's screen. Okay.
There you are.
So I am controlling this right now?
Yep.
Okay, good. All right, so Yeah, obviously, I started to say before, I don't know if I got cut off from Zoom, but it was a little challenging at first to think about piggybacking with everything Julia presented. She's obviously the authority with all things security. So I guess one thing I would start with after watching her presentation, I learned a lot too, is when I sit with retirees discuss all things pension related, obviously I come to a point in my discussions with them, whether they ask about it or initiate it, but I always defer people when they have Social Security questions to their website and to make an appointment. I think, Julia demonstrated the benefit of that. There's a lot of nuances depending on people's situations. And I can't speak to everybody's situation, and I'm certainly not a Social Security expert as well. So I always try to defer anybody that meets with me. Just know that I will always defer you to really the authorities. I want you to have the proper answers for your unique situation. I did hear when I just logged in. So am I able to let me just move something around. I just want to make sure I can move the screen. Okay, I can move the screen. It's just a little jittery. Okay, so one of the things I just wanted to touch on just for a few minutes is a couple things without, being redundant to Delia. But I think she touched on, the first point that, almost everybody, unfortunately, the woman from the library, she's probably an exception, but she'll probably have a better pension as well. I always also use that seesaw analogy. If you picture this, I usually say, hopefully people can visualize it, but when you have worked a long time for the town, you're going to get a better pension than someone who hasn't. Yes, it will be true that you'll probably get a lower Social Security benefit. That's one of the drawbacks. But then again, people in the private sector are not going to have the pension aspect to supplement income going forward every month. So, I would say don't get discouraged if you find if you thought you were going to get more from Social Security, because remember, one of the nice things is we get the pension, and most people don't. But she did touch on that almost everybody will get some sort of Social Security benefit. So I think that's good news, or at least a comfort. And she also said it wasn't really meant to live on. It's sad when some people, I guess, use that as their primary source of income in those later years, but it really wasn't constructed to be that. But now I just, my second bullet point, SRS, I also agree that schools that may be paying into Massachusetts, the same rules under Chapter 32. Not necessarily. Your pension can never be touched by Social Security. They, as I think we learned, they will only be able to adjust.
Jacob, we lost you, I think. Are you there?
Yeah, I'm here.
Okay, you're good.
I am.
Yeah, don't move, whatever you're doing.
I am down in the conference room. I wonder if I should go to my workstation and do the meeting from there. Sometimes in the office there's a little feedback when Liz is on the same Zoom meeting. But can you hear me right now?
Yes, we can.
All right, let me turn my mic up. I don't know if this helps at all. So you can hear me right now?
Yes, we can.
Okay. Well, so I'll touch on the options real quick and the retirement eligibility. To be eligible for a pension in Massachusetts, it depends on when you were hired for the first part. If you were hired before April 2nd, 2012, you're grandfathered a little bit. You can be age 55 with 10 years of service. And Delia referenced this, but there is a small distinction. Your top 3 highest salary years, and they don't have to be just in Needham either. It's in any while you were working in the public sector in Massachusetts. We understand that some people do jump around for whatever reason to different towns. So we can use your top 3 highest years if you were hired before April 2nd, 2012. There's a couple changes after 2012, April. You have to be age 60. You still have to have the 10 years of service. And then we would use your the average of your top 5 highest earning years. So a little distinction there. And then if you have 20 years of service, there's no age requirement. But depending on if we use your top 3 or your top 5, your hire date does come into play with that. But that is to meet the eligibility to receive what's commonly called a pension, but it's really an allowance to monthly payment to you for the rest of your life. The retirement options, when people go to retire, they only have to really choose one of 3 options. It's not a scary thing to go into. You would sit with me and you would have plenty of time. And I actually give people, as Liz would attest, all the time that one wants. And of course, even after our meeting, they have follow-up questions, they can reach out to me. But it's actually a very simple process from their perspective. They just have to choose options A, B, or C. I gave an example of an estimate on this page. I'll try to be, kind of simple and quick. I highlighted certain things. Option A gives you your biggest bang for your buck, if you will. I heard someone say, I think it was Sean, that he asked option B. You can see where it doesn't drop down too much. In fact, the state, estimates it from A to B only drops down, 2% or so. But you can see that, in this example, this person, if they chose option A, it's $1,465. It doesn't drop much if they chose option B. Every option has a plus and a minus, if you will. Under option A, my screen is gone. I should go upstairs and plug in. I'm gonna come upstairs, but under option A, there's no beneficiary. So when you pass away, whatever is left, except for the month you pass away, gets absorbed back into the retirement system for future retirees. Under option B, there's a time factor to it, but you can have more than one beneficiary. All these things kick in, but whatever is with option B, when you pass away, because behind the scenes, even though it's a lifetime benefit for the person, the retiree, it does actually dwindle down behind the scenes, their account. And it's exactly for this reason. When someone passes away under option B, depending on the state here says right here, somewhere between 8 and 12 years, their account really behind the scenes zeroes out. So if you live 20 years into the future under retirement option B, there wouldn't be anything for any beneficiaries at that point in time. Obviously, if you passed away, probably it would be tragic, of course. Nobody wants to see their loved one go sooner than expected. But if you did pass away year 2, year 3, whatever's left in your account at that time does get paid out to your beneficiaries as you delegate your percentages there. Option C, I call it the more spousal friendly option. Can you still hear me, Tatiana?
Yes, I can.
Okay, I'm just moving up to my office. Option C does afford 2 pensions in effect, but again, the spousal pension for the rest of their life starts at the moment the retiree passes away again. And the option C benefit is 2/3 of the spousal pension and 2/3 of the retiree's pension under option C. Now, under option C, that is also why the retiree gets a little bit less than A and B. Because when they pass away, the state in essence knows they're on the dole for another pension for the rest of the spouses. And actually, it doesn't have to be a spouse, but it does have to be a direct family member. Okay, so I just wanted to touch on that real quick. Because that's what an estimate looks like when somebody goes to retire. Can you still hear me okay?
Yes.
Okay, I moved up to my office. So that's basically A, B, and C. When someone goes to retire, I just showed you an estimate. That's where they can talk it over with their family, determine, what is best for, for them going into the future. Delia, will my pension be protected from Social Security? Yes. I already mentioned Social Security cannot touch your pension. The weapon GPO that Delia explained, I'm not gonna, I wouldn't really be able to say it better than her. However, some people have asked, I incorporated these, and I actually got to update them because mine runs that I put in my retirement packet through 2019, but I do include for everybody. That's why I did a PDF presentation. They can have this comes right from the Social Security website, but I'll get the updated version. But this shows you who
Lost you again. Jake?
Yeah.
Can't hear you. I cannot hear you.
Okay. You know what? Hold on 1 second.
Okay, now I can.
You know what? I'm gonna switch to, it's the Wi-Fi in the building. I'm gonna switch to I'm upstairs in my office. I'm gonna switch to the desktop. Tatiana, can you hear me right now?
I can hear you.
All right. What I'm gonna do is I'm gonna log into the meeting on my work machine. I have to let me in there. I'm gonna sign out for you all.
How are you doing, Jake?
I'm just signing into the meeting.
Okay, let me see if I can. I just want to make sure I can see you. Okay. So sorry about that, everybody. We're just gonna give him a few minutes to see if he can log back in. If not, we may reschedule this portion of the presentation, seeing as though we have great access to Jacob right at Town Hall. Let's see, I'm gonna try one more time. Jake, are you there? Jake? All right, well, we gave it all we could. But I want to thank Jake for for talking to us a little bit about retirement. I think we're gonna plan for another retirement presentation for the town side, just so people can get answers to their questions. I want to thank all of you for being here. This was a widely attended presentation, so I appreciate everyone taking time out of your day to be here and ask questions. There is going to be a recording of this, and I will make sure that I get back with retirement to schedule a new session. As always, if you have questions, please contact your Human Resources Department, the Retirement Department, the Treasury Department. We're all here to help you. Thank you, everybody.